It's time for Yahoo Finance's Market Minute. Stocks are lower today as investors digest a fresh wave of tariff uncertainty. Tensions between the U.S. and China heating up as President Trump claims the country violated their side of the trade agreement. Costco missing on revenue while topping expectations for earnings and same-store sales in its third quarter. The retailer is saying it intends to keep prices competitive by negotiating with suppliers to lower prices on key items. Meantime, Dell shares fractionally lower after an initial pop on earnings. The company issuing strong guidance saying it's, quote, experiencing unprecedented demand for our AI-optimized servers. Ulta shares jumping as consumers continue to spend on beauty. The retailer reporting better than expected results in its first quarter, boosting its full-year outlook as exclusive products like Beyonce's new hair care line bring shoppers through the doors. That's your Yahoo Finance Market Minute. For more on what's trending, scan the QR code below.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. And on today's show, Portfolio Checkup. It's the final trading day of May. We're digging into your investment outlook for the summer. And car prices. We're going to investigate how automakers are responding to President Trump's tariff policies and discuss the best time to buy a new car. Plus, all week on Wealth, we've been diving into the 529 savings plan landscape, and today we reveal how you can avoid 5 common mistakes that people make with these investment funds. All that and much more coming up during this hour, but first let's begin, as we always do, 90 minutes into the trading day. Stocks, they are edging lower to end the week as trade uncertainty continues to rattle investors. My next guest says that and has been using the recent volatility to shift from defensive back towards growth. Joining me now, we've got Adam Coons, Winthrop Capital Chief Investment Officer. Adam, good to have you back on with us. You're looking to buy the dip on companies with high quality earnings. Where are you finding those opportunities right now?
Yeah, I mean, it's important. If for us, we came into the year quite defensive, obviously not because we had the crystal ball around tariffs, but just because of valuations and the growing uncertainty. So as markets kind of tipped over and we pulled back through March and April, that gave us the opportunity to unwind that defensive trade slightly, moving back in towards, growth names. And so what we were doing, coming into the year, we were underweight names like Nvidia. So we used that as an opportunity when it, was trading near 100 to add. So it's really that shift back into what worked over the last 2 years, a lot of tech, some healthcare. We see that continuing to gain momentum traction through the summer and back half of this year, basically with a recovery from that dip. We think we, probably will see continued volatility, but we think we put in the lows for the year.
And so with that in mind, what does that volatility perhaps look like, especially as we have 2 major factors that the markets continue to consider? One is on the trade policy front and tariff being the word du jour pretty much every day. And then additionally, it's on the Fed side as well, and how they're going to be monitoring for what's taking place on the tariff side to make sure that that doesn't show up in some of the inflation readings. Of course, their favorite inflation print, PCE, freshly out as well today. So where's the priority really being placed?
Yeah, this is a difficult balancing act, in particular for the Fed. And so for us, we think markets are going to be mostly driven by tariffs. And we also think that the Fed's going to be driven by tariffs to a large degree, simply because what happens with tariffs is going to affect the data that the Fed's using to make their decisions. Right now, when we look at the labor market, when we look at inflation numbers, it still is relatively in favor of the U.S. economy, continuing this path of just, general growth with moderate inflation. Like I said, the question mark obviously is tariffs. And I think that's what's going to drive volatility because it's very headline driven, where, one day you're going to see Trump put them on, when the next day you're going to have him take them off. And then obviously now we have courts involved with tariffs and whether or not they're even legal. So I think the volatility really is going to be the volatility of tariffs, and then how that affects consumer confidence, what they do going forward, ultimately is going to be the deciding factor for the Fed. But we still think the Fed is going to be very slow to react, and it's going to be a largely wait and see attitude for the Fed this entire year.
And Adam, two of the top ideas that you have as well right now, one of them is Alphabet, and then the other as well is in the cybersecurity front. Break those two down for us.
Yeah, so I mean, it's similar to how it started. We think a lot of the things that worked last year will continue to work this year. Alphabet, Google has had some issues this year, obviously, the regulatory side, and then this kind of idea that Apple may, move away from, a Google AI type platform and may have to take Google Chrome off other handsets. We think that that's really just kind of a short-term event. We don't really think that's going to come to fruition. We think that the advancement out of the AI Gemini from Google is far better than anything Apple's putting out. So we think that they're going to continue to use Google's products on their handsets just to make those competitive against the Android space and anything coming out of China. So we think that when you look at Alphabet, just the overall business model, the cash generation is sound. And so that plays a little bit into the AI story. We're not heavy proponents of using the AI narrative, but where it enhances the business model, we like it. And so that's why we also like cybersecurity, because obviously this is a pie that's growing. And while we're not trying to pick these individual software players, it is very apparent that as AI advances and becomes more complicated, so will cyber attacks. And so obviously from the standpoint of corporate America, they're going to have to do a lot more spending on a more advanced version of artificial intelligence-based cybersecurity, which is where CrowdStrike and Fortinet fit in. We like both of those names. They both had tremendous years in 2023 and 2024, even with CrowdStrike's pullback with the issue with Microsoft. We see those as just, like I said, that pie that just is growing. It's a necessity. So those are the type of companies we like to invest in.
Adam, good to have you here with us today. Thanks so much for breaking these down.
Thanks for having me.
Now time for some of today's trending tickers. We are watching Airbnb and Ralph Lauren. Joining me now, we've got my Morning Brief co-host, Madison Mills. Let's set the stage here. For first up, Airbnb. Cut to sell from hold at Truist. The firm sees soft summer leisure trends and is reducing its price target on the stock here. There you're taking a look at shares of Airbnb, moving lower on this, down by about 0.25% right now, Maddie.
Yeah, lowering that price target to 106 from 112. It's not too much downside. It's really more of a forward-looking call here, which is why we did initially see shares dropping as much as 3%. We're seeing a little bit of a recovery in the ticker at the current moment. But one of the things that they talk about is just that they don't see revenue gains going forward as quickly as some other folks on the street have anticipated here. And they're specifically talking about their lodging here, not just being not being weak, but instead being softer than consensus. They talk about how they have a street low when it comes to their expectations for the third quarter in terms of RevPAR growth forecasts going forward here, and they look to be a miss versus current consensus expectations going forward, which is really interesting given the fact that we have seen Airbnb positioning itself as this company that's going to be able to withstand some of that macro uncertainty.
Even as we start to think about how there are households that are continuously running the math on where they're pulling back on some of their travel spending or some of the longer term stays and how Airbnb factors into that. It's also interesting, Airbnb came out with some statistics, all these things considered around their role economically as well, talking about in 2024, guest spending boosting the economy by $90 billion in 2024, also helping support and the influx of visitor spending in certain regions that they operate, helping support more than 1 million estimated jobs nationwide last year, new record, generating $52 billion in labor income. So looking at Airbnb and some of these other accommodation plays as their role in the economic landscape as well as economic indicators, also something interesting to track going forward from here too. Yeah. Also, we've been tracking this one, Deutsche Bank resuming its coverage of retailer Ralph Lauren with a buy rating. The coverage was suspended back in January of 2024. The firm now sees opportunity for upside. However, shares are lower, just fractionally, by about 0.1% right now.
It's interesting. They talk about all of these different areas that they are looking at when they're sussing out the health of retailers. They talk about high quality, good underlying fundamentals, pricing power, white space opportunity, and limited China sourcing. They say few companies within their coverage fit that description, but they think RL, quote, checks all of the boxes, and they think the market is still underappreciating this particular stock, especially given the fact that the company has undergone some transformation when it comes to distribution, sourcing, and they think they also have margin expansion potential going forward as well, which will certainly be a lift to earnings from here. The price target that they set implies a 25% potential upside from current levels, so certainly a bullish call here.
Yeah, absolutely. They say RL is a market share gainer, growth levels across geographies, channels, categories, more than offsetting some of the reduced wholesale doors, ultimately positioning the brand closer to European luxury peers, they say, within this rating here. Thanks for breaking these down with us.
Yeah, of course. Thank
Maddie,
you for having me.
appreciate it. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Well, coming up, with Nvidia earnings in the rearview mirror, we're going to discuss how the AI darling correlates with chip stocks, tech, and the broader market. Stocks in Translation host Jared Blikre has you on the other side of the break. Stay tuned.
If Nvidia sneezes, the whole market can catch a cold, and we've got the correlation charts to show it. I'm Jared Blikre, host of Stocks in Translation. Now, we've tracked Nvidia's correlation with chip stocks, tech, and the broader market over 6 distinct eras, from niche player to a fledgling crypto play to the AI Mag 7 era. Each chapter, it brought Nvidia closer to the center of gravity for the entire market. We're going to go over all of them, but first, let's start with this chart here. This shows Nvidia in the top panel with a log scale y-axis, and in the bottom panel, we have the quarterly correlation between Nvidia and the Philly Semiconductor Index, or SOX. That is in blue, and its 4-year average is in orange. Each of those eras we were just looking at is numbered in the chart. We're going to break those down in a minute, but first, just notice that slowly rising orange line. After 2018, in the 2 box, Nvidia's correlation with chip stocks never falls below 0.7. It is the beginning of its rise to market dominance. And the biggest spikes, the 2018 chip sell-off and COVID in 2020 and the 2022 bear. This is expected since bear markets tend to make everything move together and drive correlations up. Now, zooming out to the broader story, we still have the 6 eras in this chart behind me. This time, we're only showing the 4-year average or the quarterly correlations with Nvidia, but with 3 different markets. Nvidia versus SOX again in orange, then versus the S&P Select Tech Spider Fund, or XLK, that's in blue, and finally versus the entire S&P 500 index in pink. So in era 1, this we call niche no more. From 2015 to 2017, Nvidia was a bit player, low correlation and minimal market impact having. Era 2 is the crypto and first-gen AI liftoff. Crypto mining and early AI dreams turned Nvidia into a tech market leader. Era 3, pandemic data center boom. Nvidia's correlation shot higher in both the pandemic bear and bull markets. This is when Nvidia really became a market-leading stock. Era 4, bear market glue. The Fed starts hiking, semis collapse, correlation surges yet again. Everything falls together. Hedging stocks with stocks fails, and bonds actually make things worse. But that's a side story. Era 5, AI turbocharge. ChatGPT, it ignites the next leg higher, pushing Nvidia above $1 trillion market cap, locking correlations at elevated levels. Finally, Era 6. This is the plateau, or is it the powder keg? Recently, Nvidia has traded sideways, but correlations remain high and volatility is building. So the big question is now, what if Nvidia stumbles? A meaningful reset could shake up passive portfolios far beyond just the chip sector. And with Nvidia earnings behind us for the next 3 months, but with correlations at these elevated levels, a surprise in Santa Clara, it could quickly affect all stock investors. So stay tuned for that one. And stay tuned for new episodes of Stocks in Translation, more jargon-busting deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Jared, thanks so much. Appreciate it. 25% tariffs on imported cars and car parts are expected to create cost burdens of at least $2,000 per vehicle, according to an analysis from the Anderson Economic Group. And that estimate pushes upwards of $15,000 for certain electric vehicles and European and Asian luxury cars. Car companies are responding in kind. Hyundai weighing 1% price increases across the board, according to Bloomberg, and starting July 5th, Ford will start raising prices on 3 Mexico-built models. Here with more, we've got Brian Moody, executive editor over at Kelley Blue Book. Great to have you here with us, Brian. Are we seeing some automakers mull price increases due to the tariff environment, and how much do you expect will actually be passed on to the consumer?
Well, it might vary model by model, but what we're seeing right now is that there hasn't really been much of a price increase on new cars. In fact, year over year, it's about flat, less than 1% of an increase on new cars. That's the average transaction price. But that's because certain automakers have chosen to sort of, absorb that increase, while other automakers, Nissan specifically, have actually lowered the prices on specific models that are built here in the US. So some prices will go up. The ones that would be the most greatly impacted would be a car that arrives here to the US almost already completely built. That's the car that's going to incur the largest tariff.
And so which companies are best navigating and best positioned, I guess, going forward to also navigate that tariff risk as it relates to the consumer price?
Well, Hyundai Group is one that's positioned well, even though they are considering a 1% price increase across the board. But they do have a relatively new plant in Savannah, Georgia, which is positioned to build cars and SUVs for all of their brands. And that could be a wise move. Now, that was already in play long before the current crisis or the current administration. So that could have ended up being a wise move. Kia is also in a good position. Mercedes-Benz has actually said that they have their plant in Alabama where they're going to ramp up production of models that maybe they did make outside the US, and they're going to build them here in the US. And those companies that can do that have the option of doing that, are going to be in the best position. Also, Ford builds a very large majority of their cars here in the US.
So when is the best time to buy a car in this current environment right now?
Well, if you're already in the market for a new car, and when I say that, I mean, don't let headlines move you into the new car market. Let's say you're already there, your lease is ending, you've had a wrecked car, or your car just won't last any longer. Make that process speed up just a little bit. Don't jump in because you're afraid about what the prices are going to be if you have a good car now. But if you're already in the market, speeding that process up will help. I just don't see how waiting can help in any way, especially since we know used car prices were already going to go up no matter what.
And so what is the outlook for the summer that you're anticipating?
Gradually increasing used car prices, gradually shrinking used car inventory, a relatively healthy new car inventory, but prices will gradually creep up on many cars that you typically thought of as low price. So what we don't know is how they're going to spread out the price increases. What we do know is that there probably will be increases.
While we have you, Brian, we're also keeping tabs on the Republican tax bill that passed the House, headed to the Senate. In the bill, there is a proposal for a tax break for car purchases. Americans would be able to deduct up to $10,000 a year in eligible auto loan interest. So how impactful could this be for buyers? And what are some of the details from the best assessment that you've been able to kind of put together?
Right, so that could be a very good thing for consumers, and here's why. The affordability of new cars has been decreasing, meaning they're just becoming more expensive. Not just the price of the car, but the price of purchasing credit to buy that car, and the price of servicing, and the price of parts. So that kind of relief could move more people into the market. You should still be reasonable and get a low price car based on your budget, but that kind of thing is the sort of hidden fee that many consumers don't like, the interest rate or the service plan. So it could help greatly. Another place to look for consumers is the used electric car market. That's a great place for some bargains.
What are you making right now of just the sentiment among car brands, especially as we think about the EV landscape and how Tesla has been losing some of its luster internationally? Is that something that's also transpiring here domestically?
Yes. Well, yes, but this past month, GM, Nissan, and Tesla had pretty good months because there was increases in their electric vehicles. And remember, Tesla only sells electric vehicles. But yes, Tesla market share will continue to go down. And that's simply because there's more options. Think about when Tesla first introduced the Model S and the Model X. Years ago, there wasn't much competition. Today, there's plenty of competition from brands like Nissan, Ford, Honda, and others.
Brian, great to see you. Thanks so much for taking the time here with us today.
Thank you.
Coming up, why now? More than ever, home buying is about one thing: location, location, location. You may have heard that before. That's next on Wealth. Let's get a check of the markets here as we are 2 hours into today's trading session here, and it is the last trading session in the month of May. Take a look how far we have come over that month. We are up on the Dow Jones Industrial Average by about 3.8%. The NASDAQ Composite, though, we're seeing some slippage here today. We are still higher over the month by about 9.5% here. And over the past month, the S&P 500, you're seeing that up 6%. And of course, let's put these moves in context as well. This is coming after some pretty severe declines and then rebounding that we did see towards the back half of the month of April here. So much of that continuity taking place during the month of May as well here. And this is a key level that we're going to continue to watch here, especially as we look at this year-to-date chart. We're not quite back at some of the all-time highs here, but the economists and a lot of the investment strategists that we speak to here on Yahoo Finance at least say that they believe that the bottoms that we saw in early April, when there was much of that peak uncertainty around tariff policy, they believe a lot of that bottom is set in at this point here. So the major averages here on the day, intraday, they are mixed. However, it's been pretty solid over the course of the month of April. Let's take a look at some of the sector activity that we're also seeing here on the day. We are mixed during today's session. Energy, that's bringing up the caboose. That's down 0.7%, been negative all day. The S&P 500's consumer staples, XLP, that was negative to start the day, and now it's leading. Don't call it a comeback. It's, well, yeah, you can call it a comeback if you want to. It's up 0.7%. And the NASDAQ 100 will ride out with a quick look at the NASDAQ 100, a portion of the NASDAQ composite here, and taking a look at some of those mega cap tech stocks. We'll see if Nvidia can get into positive territory, back into positive territory. It started there at the beginning of the day, but as you can see, post-opening cross and some of that hyper waffling we saw, ultimately we've moved lower by about 2% at this point. Microsoft holding on to gains, Tesla holding on to gains, but some of the other Mag 7s, they are seeing some slippage right now. There are nearly 1 million active home listings in the United States, a level that has not been seen since before the COVID-19 pandemic 5 years ago. So, could the housing market sneakily be improving despite persistently high mortgage rates and home prices? I want to bring in Cameron Chesley, who is the CS Luxury Group real estate founder and team leader. Cameron, good to have you here with us. Are we finally seeing some good news for buyers?
Yeah, Brad, that's a really good question. It's definitely an interesting time in real estate, the residential space specifically. So we're seeing a couple of different things going on. So higher mortgage rates are obviously here to stay. There's some economic uncertainty that's sort of holding. And then at the same time, like you mentioned, rising inventory rates. So if we look across the country right now, there's about 900,000 homes on the market nationwide. And as you pointed out, that's more than we've seen in about 5 years, but it's still lower than historical average.
And so as you think about mortgage rates and where they need to get to in terms of being a sweet spot, where do you see mortgage rates going through the rest of the year? What's the forecast there?
It's a difficult one to predict, but there are folks out there who are saying that it's likely to hold. Even if they do come down, they're likely to hold at least at 6.5 or above, which relative to historic averages over time is still below. So 7.7 is about the historic average. They're also saying that as rates come down about a point, it's about 5 million new buyers that are likely to enter the market. So tough to predict, but likely above 6.5 for this year. Still a very competitive housing market for some buyers. Really depends on location and price point. And so in the city, I'm here, as you can see, in downtown Boston, higher prices in the city is a little bit less competition, but as you move out to the suburbs, we're seeing multiple offer situations. And, if we look at the deals recently that I partook in, we just beat out 25 other offers on a home in the suburbs. Not common everywhere, but it's very segmented and pocketed depending on your price and, as you mentioned earlier, location.
I wonder what you're extrapolating and able to extrapolate perhaps from what you're seeing in Boston to some of the other major metropolitan areas and where perhaps even among the pulse check that you may get among some of your colleagues within the industry, what they're hearing in those major metropolitan areas as they're trying to move properties.
Yeah, I think some of the secondary homes, so a lot of the post-COVID boom of homes and the remote workspace allowed for folks to relocate to secondary markets. A lot of those secondary markets, I've heard places like Miami, for example, there's a little bit more excess inventory than we're seeing across the more traditional sort of primary urban markets like Boston. So what you're seeing is in pockets still, there is an excess of supply with still relatively high demand. It's a little bit streaky. As rates in the news cycles move, buyers sort of re-engage and reactivate, and then it slows down a little bit. We are in a period of spring seasonality right now. So those other markets that are typically a little bit warmer have less seasonality than we might have given the location in the Northeast. But seasonality definitely comes into play. And so those markets that tend to be warmer weather markets don't fall in line as much with the seasonality swings. But we in Boston are kind of in that spring up market where it's really competitive for buyers, and sellers are starting to list more and more. We're seeing across pretty much every neighborhood and price point more homes hitting the market. Any
tips for home buyers heading to open houses this weekend?
Yeah, it's always a changing market. So the one thing we always recommend is start early, get a clear sense of inventory, just get out and look at properties. Right now, what you'll see is different segments of the market tend to have multiple offers, and a few blocks away or a few neighborhoods away, there are homes with less competition. So start early, be patient. Low inventory is tricky. Multiple offers can be frustrating. In this market, it's a little bit hard to predict right now where you're going to run into those. The other thing I would say is if you're able to buy now, refinance later. As we mentioned, when mortgage rates come down about a point, you're likely to see a lot more competition and the prices resume that upward swing that they've been on, though recently it's been modest. The other thing, two quick things I would say is watch days on market. So if you're really looking for a deal and there's a property you've had your eye on that's been on market more than the neighborhood average, that's a good place to go and start having a conversation for a negotiation on a price that actually might come down. And then the other piece would be new construction. So a lot of new construction properties don't list all of their inventory at one time. They roll them out in waves. And if you're willing to be flexible with your location, there's pretty much new construction in almost every neighborhood. So if you're able to link up with a reputable local agent and get access to some of those additional options that are off market, commonly in new construction, it's a great way to sort of get an idea of additional inventory and then start to learn that market.
Interesting. Cameron, thanks so much for taking the time here with us.
Appreciate it. Thank you.
Coming up, are you thinking of asking your boss for a raise? We get some tips from an expert on the best ways to negotiate for more with your employer. That's next on Wealth. Health savings accounts could get a big boost under President Trump's tax package. The legislation passed by the House now heads to the Senate for consideration. Here with more, we've got Yahoo Finance senior columnist Kerry Hannon. Kerry, there are a ton of changes to HSAs under this legislation, but let's start with the big one, increased contribution limits. What are we seeing there?
Yeah, Brad, absolutely right. This is one sort of glimmer in this bill that I think is worth noting, is they're talking about doubling the annual contribution that people can make into these health savings accounts. And so it would go to $8,600 for individuals and $17,100 for joint or family plans. This is a huge jump of what people can set aside. Now, again, just as a reminder, these health savings accounts, these HSAs, are for people that have high deductible healthcare plans. So what that means is this year, if you're an individual, your deductible would be $1,650, or if you're a family plan, it would be $3,300. So just understand who we're talking about. Now, quickly, I just want to say why I absolutely love HSAs. And many financial planners say this is a terrific retirement tool for people if they focus on saving in these accounts for the long-term medical costs for the future instead of using them for the immediate costs, which is what most people do. What these accounts have, Brad, are the triple tax advantage. No other account is like this. You don't pay tax going in with the money. You don't pay tax on how the money grows in these accounts, nor do you pay tax when that money comes out if it's for a qualified medical expense. So this is something that unfortunately, a lot of people don't pay attention or don't understand the investment aspect of these accounts. And also a small percentage of people really are taking advantage of all of this because they're not even putting the full amount they have today because they're concerned about paying, they're saving and paying for many other things in their life. So it's just one thing that I think this is a bright light if people can put more aside in these accounts.
There's also a bit more flexibility for married couples under the bill. What does this entail exactly?
Right, Brad. So there's lots of other little pieces to this. One is that for married couples, right now, if you have a flexible spending account, one spouse says the other one has an HSA, you can't contribute to both. So you have to select one to do. Now this will open this up that you'll be allowed, spouses can do both plans. If one has one has the other. The other thing is that it will allow people to can combine them in one health savings account, both spouses, their contributions and their catch-ups. And this gives it a bigger oomph in terms of if you're using it as an investment account. But Brad, there's some other fun things in there as well. Like, for example, you'll be able to use these accounts for many gym memberships, which is something that they consider that now or they would consider it a qualified medical expense. Or if you have one of these concierge medical plans where you pay an annual fee, they're going to let some of those be considered qualified costs as well. So, and they've expanded the kinds of plans that can offer health savings accounts. So I think we're seeing some more movement to kind of give some juice to these HSAs, and hopefully it can be helpful for many people saving for retirement and saving for today's medical costs.
Wage growth has slowed as we get further away from the post-pandemic job market boom. Annual wage growth slowed to 3.6% in April 2025 from a peak of over 9% in 2022, according to Indeed's wage tracker. And according to the Conference Board measure of CEO confidence in collaboration with the Business Council, the share of CEOs planning to raise wages by 3% or more in the next year fell to 58% in Q2, down from 71% in Q1. Joining me now, we've got Priya Rathod, who is the Indeed career trends expert. Priya, good to have you here with us. I mean, most people are focused on increasing their wages, but you say that they should look at their total compensation. Just break down what this means.
Yeah, so as you mentioned, Brad, wage increases just aren't happening as much in today's economic climate. And so there are other things that employees can do to enhance their compensation. Things like asking for additional PTO, better 401k contributions or stock options, perhaps a learning or a wellness stipend, and retirement matching. So there's a lot of different benefits that employees can ask for in lieu of wage increases. And right now, many employers are open to these benefits instead of direct and permanent salary increases.
So how can you quantify your total compensation?
So I think you need to do your research ahead of time and understand what is important to you and what's available out there. So tools like the Indeed Wage Tracker and job postings with listed benefits are going to help give you a sense of what's typical for your role. And then you have to understand, Brad, what is important to you right now? Is it growth? Is it time? Is it health? Is it money? And from there, you want to pick 1 to 2 high impact asks and be clear in how they'll help you grow your role. So I think quantifying your overall compensation is really dependent on what makes sense for you as an individual. And then you have to be prepared to go in and negotiate for those asks.
And so what are your tips for negotiating a raise?
Yes. So preparation is the name of the game. You want to use tools like the Indeed Wage Tracker. You want to look at job postings. And then you want to also understand that in the economic climate we're in today, many employers and managers have an expectation that you will negotiate things other than salary. So they're generally open to the discussion, which can help employees go in with a higher level of confidence. And then be prepared. Lead with gratitude, share your enthusiasm for the role in the company, and position your ask as a way to set you up for long-term success. So for example, I'm really excited about continuing at this company. As we finalize my compensation going into next year, I'd love to explore whether there's flexibility on professional development, since continued learning is important to me. So again, be prepared to ask for what you want and be prepared to discuss how that's going to enhance your role at the company.
And so what are the tips for negotiating more benefits if you don't exactly get a financially specific raise?
So I think, again, you're going to want to think about what makes you feel supported and productive. Is it time, money, health, and growth? And understand what your stage of life and circumstances are right now. So again, for instance, Gen Z wants more flexibility and feels more burnt out. So someone in that case might ask for more flexibility, might ask for more paid time off. Conversely, if you're approaching retirement, you might say, I want to maximize my 401k contributions, or I want extended healthcare benefits. And so you really need to figure out what is important for you and then understand what benefits your company offers and be prepared to discuss how what you want will relate directly to your continued productivity at the company.
What is the best time of year to negotiate and to start those conversations, knowing when companies typically have their seasonal discussions and resource planning so that they can best prepare for both financially as well as headcount allocation, what is going to be possible?
Yes, that's a great question, Brad. I would say a couple of things. One is a lot of companies work off of wage increases or benefit increases based on your review cycle. So really understanding when is it that your performance is going to get reviewed and how you go into those performance review discussions prepared with what you would like to ask for. I think also as companies head towards the end of their fiscal years, now that can be the end of the year, or some people end their fiscal years in March, you want to go prepared into that final review discussion of the year, understanding what you want, because that is when the company is making decisions about what they're allocating for the next year. So again, think about your review cycle and the company's fiscal year and go prepared as such.
Priya, good to see you. Thanks so much for this very helpful advice. Appreciate it.
Always good to see you too, Brad. Thank you.
Coming up, everyone, it is the final installment of our special 529 Savings Plan Week, and we're going to send you off to the weekend with some tips to avoid 5 common mistakes with these education savings plans. Stay tuned. All week on Wealth, we've been diving into 529 college savings plans, how to open, use, and manage this plan. Today, we're going to talk about common pitfalls that people encounter with these accounts. For more, we've got Rich Palomini, who is the head of education savings programs over at Merrill Wealth Management. Good to have you here with us. Rich, you lay out 5 common mistakes with 529 plans. Pulling money too early, not coordinating with financial aid, forgetting to reduce risk as college nears, and not understanding qualified expenses, plus not understanding tax benefits. So let's break down each of these, starting with pulling money too early. What is the issue there and how can people avoid it?
Yeah, so it really boils down to not properly timing your withdrawals. The IRS rules for taking withdrawal allow you to either make a withdrawal directly to the school for things like tuition, room and board, etc. But it allows you to reimburse yourself for other expenses that you wouldn't pay directly, such as books, a laptop, other supplies, and so forth. However, the IRS rules for taking those qualified withdrawals require that the withdrawal is made in the same calendar year as the expenses were paid. So for example, if you purchase books or a laptop for your child or your beneficiary in September, you want to be sure to take that 529 withdrawal no later than December 31st, that same calendar year, to avoid the IRS potentially not allowing it as a tax-free withdrawal.
Another mistake that you commonly see, not coordinating with financial aid. So what's the issue there?
Well, it's really about understanding the financial aid rules, right? And they do change often, and they've changed over the last couple of years. But the first thing is, many families think because, they invest in a 529 or a 529 is earmarked for education, it is going to be more detrimental to you than investing in other accounts. And that is just simply not true. 529s are treated as a parental asset, and therefore no more than 5.6% of it will be weighted against you in the federal financial aid formulas. It has a relatively small impact. On the other hand, if you invest those same assets in an account where the student is the account owner, such as a UGMA or UTM custodial account, those assets are looked at less favorably in the financial aid formula, and 20% of those assets will be weighted against you in the formula. So about a 15% difference in how those assets are treated. So 529s are treated much more favorably.
And so you also see people forget to reduce risk as college nears. What exactly does that mean?
Yeah, so a 529 is an investment account. It's invested in the market. So as your beneficiary is nearing college age, it's important to start reducing risk by allocating a portion of your investments or reallocating a portion into cash equivalents to cover your near-term expenses. Let's say the next 12, 15 months of expenses. This strategy provides you a cushion from short-term market volatility, as we've recently seen, while also providing a peace of mind that you can cover the near-term expenses regardless of what the market is doing at that particular time when you need to take the withdrawal.
And then while we have you, another common mistake, people don't understand what a qualified expense is. How can you avoid that?
Yeah, so the good news is qualified expenses has really been expanded over the past several years through various legislation, right? So when we first started with 529s, it was purely college, right, post-secondary, and you could use it for tuition fees, room, board, book supplies, equipment, etc. Over the years, it's been expanded. Now you can use it to pay off up to $10,000 in existing student loans. You can use up to $10,000 a year to pay for K through 12 public or private schooling. You can use the money to pay for expenses related to apprenticeship programs, things like books, tools, equipment, and so forth. So it's really important that you understand what is a qualified expenses versus what is not a qualified expense. For example, we often get calls from clients saying, I want to purchase a car or pay for airline tickets with my 529. And that is not a qualified expense. So if you do take a withdrawal for that purpose, you are going to be subject to income tax and potentially a penalty on the earnings portion.
Rich, great to have you break down some of these common pitfalls. We appreciate it.
Thank you, Brad. Have a great day.
You too. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination coming up 3 p.m. Eastern Time. They'll count you down to and through the market close.